All right, if you're here right now, you're probably watching silver and wondering how $21 just vanished like it fell through a trap door. I'm glad you clicked, because this literally just happened, and the speed matters more than most people realize. We're talking about a $21 drop in a compressed window after silver kissed $120 and then failed. And here's the thesis you need to hear right now. This wasn't random, and it wasn't panic out of nowhere. Stay with me for the next 15 minutes, because I'm going to show you exactly what triggered this move, how you can spot it next time before it happens, and why this might be less about silver fundamentals and more about tightening conditions across all markets. If you're holding silver, if you're watching it, or if you're just trying to understand what's real in this market, your job is to understand what just played out. Now, before I explain what caused this drop, let me teach you something most people never really internalize. Markets don't move because of headlines alone. They move because of positioning. Think of price like a crowded elevator. As long as everyone's leaning the same way, it feels stable, right? Everyone's balanced. But once one person stumbles, suddenly there's no room. Everyone shifts and gravity takes over fast. That's what leverage does in markets. When price rises fast, leverage piles in quietly. You don't see it on a chart. You don't see it in the headlines. But it's there, stacked floor by floor, position on top of position. So when price stops going up, it doesn't just drift lower like air slowly leaking from a balloon. It snaps. It breaks. And that snap is what you just witnessed. Here's what you need to know about parabolic moves. They're fragile by design. When silver ran to $120, it wasn't just investors buying coins or bars for their safe. It was futures traders, options desks, momentum funds, all of them layering exposure on top of exposure. The higher it went, the more mechanical buying kicked in. Algorithms see momentum, they buy more. Trend followers see a breakout, they pile in. So when it failed at that level, the market wasn't asking philosophical questions like, is silver still valuable? It was asking, who needs to get out right now? And that's a very different question. If this is making sense so far, drop a comment below and let me know where you're watching from, because I want to know who's paying attention to this pattern. Now here's what's actually happening under the hood. Let me break down the sequence step by step, because this is where the real lesson is. The primary driver, the thing that started this whole chain reaction, was a sudden resurgence in the US dollar paired with rising yields. That matters because higher yields raise the cost of holding leveraged positions, especially in non-yielding assets like silver. Silver doesn't pay you interest. It doesn't pay dividends. So when yields jump, the opportunity cost of holding silver increases, and the cost of borrowing to hold leveraged silver positions goes up. That's pressure. Real pressure. So when yields jumped this week, silver stalled. That stall at 120 was the trigger. Once that level failed, stop losses fired automatically. Those stops weren't emotional decisions. They were programmed orders sitting in the system waiting to execute. Those stop losses pushed price lower, which triggered margin calls. Margin calls forced selling. And forced selling hit thin liquidity. Because here's the thing, most buyers were already in. They'd already bought. So when liquidity thins out like that, every single sell order does more damage to price. Here's what's wild about this whole thing. The selling wasn't emotional. It was mechanical. Algorithms don't care about long-term silver demand fundamentals. They don't care about inflation narratives or monetary debasement. They care about thresholds. They care about levels. So when those thresholds broke, paper silver flooded the market in minutes. Futures contracts, options positions, all unwinding at the same time. This is why the drop felt violent. Not because everyone suddenly hated silver or lost faith in the story, but because too many people were positioned the same way at the same time. And when everyone's leaning the same direction in that crowded elevator, one stumble creates a cascade. But here's the part that should make you nervous. This kind of unwind doesn't stay neatly contained in one market. It tells you stress is building somewhere in the system. When you see mechanical liquidation like this, it means margin pressure exists. And margin pressure in one market often means deleveraging is happening across multiple markets. That's the second layer most people miss. While everyone's watching silver's price, I'm watching credit spreads. I'm watching volatility indices. I'm watching how other commodities are behaving, because they're all connected through the same funding markets. When dollar strength accelerates and yields rise together, that's a liquidity tightening signal. It doesn't just affect silver, it affects anything held with leverage. And right now, that's a lot of positions across a lot of markets. The convergence is what matters most. You had dollar strength hitting at the same time yields spiked. At the same time, silver hit a psychological level where everyone and their cousin had stops clustered. That's not coincidence. That's structure. When those three things converge, price doesn't need a fundamental reason to collapse. The mechanics take over. The elevator's already too crowded, and someone just pushed the emergency stop button. What happened next was physics, not sentiment. Now let me show you what very few people are talking about right now. The options market was completely lopsided going into this move. Open interest in call options at strikes above 120 was massive. That means dealers were short those calls, and they were hedging by buying futures. As long as price was rising, that created a positive feedback loop. Dealers buy more futures to hedge, price goes up, more calls go in the money, dealers buy even more futures. It's called a gamma squeeze, and it works beautifully on the way up. But here's the problem. It works in reverse too. When price started falling, those calls went out of the money. Dealers didn't need the hedges anymore, so they sold futures. That selling pushed price lower. More calls went out of the money. More hedges came off. More futures selling. You see the pattern? It's the same elevator problem, just described through options mechanics. And it amplifies moves in both directions. This is the exact same playbook we've seen before, and I want you to see the pattern clearly. Go back to the silver spike in 2011. Once the parabolic phase broke and silver topped near $50, margin hikes and forced liquidation crushed price far faster than fundamentals changed. The story didn't change overnight, industrial demand didn't vanish, but the leverage unwound, and price collapsed from 50 to 30 in a matter of weeks. Same mechanical process. Look at gold in 2020 after its sharp pandemic surge past $2,000. The pullback wasn't about lost faith in gold as a safe haven. It was about leverage resetting after a crowded positioning extreme. Even equities show this pattern. Think about volatility spikes after crowded momentum trades unwind. February 2018, the vol-pocalypse. September 2020, the tech pullback after the work-from-home surge. Every time you see extreme moves creating extreme positioning, the unwind eventually snaps. When you zoom out and look at decades of market history, you see the same story over and over. Extreme moves create extreme positioning, and extreme positioning eventually snaps back. It's not a question of if, it's a question of when. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be manipulation? People love that explanation, and I get it. And sure, large players absolutely use liquidity windows to their advantage. They know where stops are clustered. They know when liquidity's thin. Could some of this move have been engineered by someone with deep pockets, pushing price through key levels to trigger cascades? Maybe. It's possible. But here's the thing. Blaming manipulation misses the actionable lesson. The market only becomes easy to push when it's already off balance. You can't manipulate a market that's not over-leveraged. You can't trigger a cascade if there aren't stops stacked up waiting to get hit. So instead of focusing on who might be pulling strings, focus on what you can control. Watch leverage. Watch momentum exhaustion. Watch key levels where everyone agrees something can't happen, because that's where risk actually lives. That's where you can position yourself differently than the crowd. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. First, you might be long silver and feeling that pit in your stomach. Maybe you bought near the top. Maybe you're holding physical and watching the dollar value of your stack drop 20% in a week. That's understandable. That feeling is real. If that's you, your job right now isn't to predict the bounce or guess where the bottom is. Your job is to assess your exposure honestly. Are you forced to act if price moves again? If you're holding physical with no leverage, You can afford to wait. You're not getting margin calls. But if you're holding futures, if you're holding leveraged ETFs, you need to know your pain threshold. Don't let the market make decisions for you. Make them consciously before you're forced. Second, you might be on the sidelines feeling like you missed everything. You didn't buy the dip at $80. You didn't catch the move to 120. And now you're watching this drop thinking you missed it again. If that's you, here's the good news. The most dangerous part was the euphoric top, the part where everyone's talking about silver going to 200, to 300, where new buyers are piling in based on YouTube thumbnails and Twitter hype. You avoided that. Patience is a position. Cash is a position. And honestly, the fact that you're here watching this and learning instead of panic buying or panic selling puts you ahead of most people in this market. Third, you might be trading this actively. Maybe you're in and out, scalping moves, playing volatility. If so, I respect that. But zoom out for a second. Volatility cuts both ways, and the spreads widen when liquidity disappears. Your fills get worse. Your risk increases. Slippage eats profit faster than you think. For all of you, no matter which category you're in, the universal principle is the same. When leverage unwinds, survival beats bravado. Protecting capital matters more than catching every move. And understanding what you're actually watching, that's what separates people who last in this market from people who get wiped out chasing. So here's what I want you to answer in the comments. Which type are you? Are you holding and reassessing? Are you waiting on the sidelines? Are you trading actively? Let me know, because I want to understand who's in this community and how you're thinking about this move. So here's where I stand personally. I'm not bearish on silver long term, and I'm not chasing it blindly either. I'm neutral and alert, which I know isn't the sexy answer people want to hear, but it's the honest one. Let me tell you what I'm personally watching right now. First, I'm watching yields, because they're the pressure valve for this whole system. If yields keep climbing, that pressure stays on anything leveraged and non-yielding. If yields roll over and start falling, that releases pressure and gives silver room to recover. Second, I'm watching the dollar, because strength there tightens everything else. A strong dollar makes commodities more expensive for non-dollar buyers. It tightens global financial conditions. It matters. Third, I'm watching how silver behaves on any bounce attempt. Does volume come in and confirm buying interest, or does it fade on low conviction? That'll tell me whether this is just a pause in the unwind or the start of actual accumulation. Based on my analysis, this drop was mechanical and technical, not fundamental. The fundamental picture for silver hasn't changed in a week. Physical demand didn't vanish overnight. The supply deficit story is still there. The industrial use case for solar, for electronics, for electric vehicles, that's all still growing. Monetary concerns about fiat currency debasement, those haven't gone away. What changed was positioning and leverage. That's it. If history rhymes and silver finds support and stabilizes above $100, the move that follows could be significant, because weak hands just got shaken out and positioning just got reset. But I'm not making predictions. I'm watching conditions. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Think independently. That's the whole point of this channel. If you made it this far, you're the kind of person who thinks critically instead of reacting emotionally. And that mentality will serve you well in every market you ever touch. If this breakdown helped you see the pattern more clearly, share it with someone who needs to understand what's actually happening instead of just watching prices move. Subscribe if you want more breakdowns like this when markets move. Stay sharp out there. Think critically, verify what you're seeing, and make your own decisions. I'll see you in the next one.